We've talked a lot about the four T's: tech, trade, Trump, and tariffs. Maybe the one thing we have not talked enough about is the amount of repatriated money that is still to come into the United States because of maybe the fifth T, the tax bill. How much more money do you think that we're going to see come into the United States that could also go into stock buybacks, helping give another leg of floor underneath the U.S. market?
Good morning. Now, absolutely, repatriation is one of the key drivers that we see for US equity markets this year. Already so far, we've had extremely high levels of share buyback announcements, and many of those announcements haven't yet actually been executed. So that should continue to support US stock markets into the end of the year. And of course, it's not just companies buying back their stock, it's also M&A, which is also reaching record high levels as companies seek to buy growth, particularly as we head towards the latter stages of the cycle. So we've seen lots of it so far, but we do think it'll be a reoccurring theme into the end of the year.
How much will it matter, Grace?
It is an incremental buyer in the US equity market. When you look across which sectors benefit the most, tech, healthcare and energy are sectors that benefit from overseas cash being repatriated into sectors where balance sheets are already pretty strong and therefore excess capital can be returned. So we do think it's going to be one of the key drivers, and those are the three sectors that we're most focused on at present when it comes to capital allocation.
Yeah, and what else looks good out there then?
So the US is still our preferred equity market. Other than capital deployment, the sectors that we're focused are on those that, as we head towards the latter end of the cycle, offer secular growth as well as cyclical growth. So technology and healthcare are two of those sectors that look particularly good to us. When you look outside of US markets, the value opportunity that we see emerging is in emerging markets, and most notably China, because of the large drawback that we've seen in Chinese equities over recent months. And obviously you've seen some of the stimulus coming back into Chinese markets from policymakers, and it'll probably be another month or two until we really start to see that stimulus showing up in the data, but we do think that will afford Asian equities some support going through the end of this year as well.
So you believe that with China's drop, it is cheap, but cheap in a good way, not cheap for a reason?
Absolutely. Ultimately, when you look at Chinese valuations, they've pulled back towards the low end of the historic range. And that tells you that market and investors are fearful that earnings are going to significantly roll over, whether that be as a consequence of the deleveraging that the Chinese are undertaking, or indeed trade overhangs that have been much discussed. Our sense is that Chinese earnings will prove to be reasonably resilient. We do think that GDP will slow into next year, but to a manageable level, and that corporate earnings will remain robust. And therefore, we think that the pullback is overdone on negative sentiment, and it's time to start dipping your toe back into Asian equities.
And finish this sentence for us. We'll play a little game here in the morning, Grace. The biggest risk to your thesis right now is what?
Trade. It's trade, because ultimately that has a huge impact on sentiment, and at the moment, that's really drawing down earnings multiples. That's been the contraction that we've seen, including in the US market, around the world. Global equity indices have seen a contraction in the PE multiple, representing greater risk, a higher risk premium, and we think the number one reason for that here and now is trade. Following on from that, I would say the US yield curve, the flattening we've seen in the 2s10 spread is also something that we're watching.